got Suyog Kotecha, CEO and Executive Director at Aarti Industries, joining in on the show right now to talk about how their quarterly performance was. Suyog, good to have you in ET now. Thanks for your time.
Morning.
A strong commentary coming in from you to try and deliver the strong growth in the MMA, which clearly was led by expanded capacity at, I guess. Tell me, what kind of incremental growth are you looking at for the full year? And if you can give us a guidance.
So I think obviously we ended the year strong in line with our revised guidance, which we announced in the Q3. Overall, if you look at year on year, it was almost 15 to 17% kind of volume growth across different product portfolio. In many of our value chains, we completed our capacity expansions, which started coming on stream towards the third, fourth quarter. And that should now sort of give full year volume-led growth for the coming financial year standpoint. Demand trends continues to look pretty robust across end markets, ag, energy, polymer, dyes and pigments, sort of our large end markets. Across most of the end markets, we are seeing demand trends continue to sort of remain robust. On margin, things haven't changed. I think we continue to see sort of bottoming out of margin. We are not seeing further reduction. At the same time, we are not seeing significant uptick as well. So right now, the way we are looking at next 12 months time frame is sort of mostly volume-led growth at current level of margin. That's how we are planning for it. From an outlook point of view, as we said last time, I think we've given a sort of 3-year outlook, which is sort of almost doubling of EBITDA compared to where we are. We're talking about 800 to 2,200 crores kind of EBITDA over a 3-year time frame. And the levers which will deliver that has also been very clearly articulated across, cost optimizations, operating leverages in the existing capacities and the new Capex-led growth. All of those initiatives remain on track. So we still maintain the 3-year outlook as of now.
Where is your Capex cycle moving? You were in the middle of a large Capex cycle. How much of that has got concluded now?
So I think Capex cycle, last year we peaked in terms of annual Capex. We did roughly 1370 odd crores of Capex last financial year. This year, we will taper it down to 1,000 odd crores. The target is to keep it in 3 digits for this year. And then we should see sort of significant reduction in the year going forward. Most of the current Capex is going to our greenfield site, Zone 4 in Jagadia. Is the entire chlorotoluene and downstream chain, which we have reconfigured to be a little bit more multi-purpose across different products. And that remains the focus area for this year as well.
And because the Capex cycle has peaked, when will the advantage of the capacity, when will that start kicking in?
So most of Zone 4 will go through staggered commissioning throughout this financial year and maybe first quarter of next financial year. The actual benefit of it will start seeing in FY26-27, right? That's when the entire asset is sort of up and running. And given it's mostly specialty, it's not like immediately within 1 or 2 quarters, you reach capacity utilization levels of 70-80%. We will see a gradual ramp up. But the real benefit to the top line, bottom line, I think we should start seeing it in FY26-27 timeframe.
All right. So the other theme that is playing well for the specialty chemicals is the China Plus One theme. Though it's not a new theme that we are discussing, but with the recent tariff news flow, do you believe that there stands a chance where the industry as well as you stands to benefit? Give us some sense there. Are there any segments which have already started the demand seeing a pickup?
So look, I think it's been extremely volatile over the last 3 months, right? We've seen tariffs for India, go up from nothing to 10 to 26, going back to 10. China went all the way from 10 to 30 to 145, now back to 30. So it always we have to look at where it settles down ultimately. But given what we saw in terms of volatility over the last 3 months, there were some value chains in which we saw positive momentum, like, for example, phenylene diamine is one of the value chain where we compete mostly with China. And given, the US-China tariff discussions in the first quarter, we are seeing significant uptick on the PDA volumes, which is exported mostly to US. At the same time, there are other molecules where the absolute cost also matters to end consumers, and in that context, even the incremental 10% tariff does hurt us from an overall viability point of view to end customer. But I think from an industry point of view and also from an Aarti industry standpoint, I think what we continue to push for is, we call it 0 for 0. I think that's the best case scenario for India, and we will see where it settles down.
Quarter gone by, exports were up. Was that largely because of a lot of restocking which was happening, because tariffs were kicking in from April? Because what we are discussing with you are numbers for the quarter gone by. We're in middle of May. Is that same momentum still on?
I think, frankly, Nikunj, I don't think the quarter 4 saw a sort of stocking up phenomena, because nobody anticipated what will get announced on April 1st week. There was a little bit of chatter, but the extent of it, I don't think was clear. But yes, in this quarter, as the quarter is going by, we are seeing, a few of the clients trying to stock up, given, there is still not very much clarity in terms of what's going to happen July 9 onwards, right? When the 3-month phase sort of gets over. So last quarter, not much of an impact from a stocking up point of view, but this quarter we might see some accelerated imports by the US company specifically.
All right, so Yoga, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us.
Thank you.
But with this,
if you like this video, then like, share and subscribe to ET Now.